Okay, tēnā koutou, tēnā koutou, tēnā koutou katoa, ko Dominick Stephens aho no te tai ohanga. I'm Dominick Stephens, Chief Economic Advisor at the Treasury, and welcome to our post-budget economic update for 2024. So we've got sort of 20 or 30 people in the room, and a vast majority of attendees are actually online, reportedly. So thank you for those who've chosen to keep me company in person, and welcome to those who've joined us online. I was inspired to do this post-budget economic and fiscal update when, for those who attend our Treasury Guest Lecture Series regularly, you would have seen a couple of months ago we had the IMF. Roy Mano from the IMF came over and gave us the IMF's latest World Economic Update. And I thought, well, hang on, we should be doing this for our people here in New Zealand and giving a regular economic update. And just after budget seemed like a great time to do it. And I also, we go out and give these presentations to boards and to various organisations from time to time. So we thought it'd be great to do it sort of for our own people and at our own lecture. Now, what I'm doing today really is talking about how the Treasury saw the economy evolving as we went into the budget, how that affected thinking around the budget, and how the budget in turn is affecting the economy. So it's an economic update with a lot of focus on fiscal, but I'm here to talk about the way that fiscal policy and the macroeconomy interact rather than sort of individual budget initiatives. You know, I'm not planning to talk to that today. And I'm also planning to really explain rather than reveal anything new today. Just before we get underway, for those in the room with me, if you need the loo, just down there through the doors and to the left. If there's an earthquake, drop cover and hold. And if there's a fire, please follow Treasury staff out through the stairwell and fire exit. Okay, so let's get underway. Just making sure the clicker works. Hold on button. Thank you very much, Hannah. So technology diffusion in New Zealand isn't great for our productivity, I hear. Okay, so the upshot for today, Treasury has been forecasting for some time an economic downturn associated with high inflation and interest rates constraining economic activity. That downturn is here, it's real, it's probably here sooner, and will certainly be deeper than we'd previously anticipated. It's not just the short-term downturn, though. Over the coming 5 years, we are still expecting a recovery, but the 5-year economic outlook has been downgraded compared to our previous assessments. That downgraded economic outlook means that the revenue forecast was lower. So Treasury essentially went to the government and said, look, the economic outlook is not as strong, there's not as much money in the tin, revenue forecasts are lower than they were previously. Therefore, deficits are larger than were forecast at previous budgets. The government has taken a range of decisions, and on balance, those decisions have partially offset that, so moved us back in the direction of smaller deficits or a sooner return to surplus. So those are the 5 main points of the presentation as I move through today. Just getting into a bit more detail, starting out with the global economy. So around the Western world, countries or advanced economies are experiencing much the same thing as New Zealand. We had lots of inflation. That required a monetary policy response. That led to a downturn in a lot of Western economies. Latest update, it has turned out that inflation has been a bit more persistent than previously expected, but economies have proved more resilient to the disinflation process than anticipated, particularly in the United States. So actually, when you balance those two things up, as our IMF colleague said a couple of months ago, there's been a bit of an upgrade actually to the global economic outlook. Meanwhile, China is a little bit different. They came out of COVID a little bit later. Their economy is still bouncing back from COVID. Production's back on stream, and lots of production has meant actually low prices. So they've got zero or even negative inflation. However, China is in a bit of a consumer and particularly a property slump at present. And that slump in property, consumer sort of downdraft in China, well, that's something that New Zealand exporters are really exposed to. So if we think about our export sectors on the left panel here, you can see visitor numbers into New Zealand. Visitors from the United States and other countries have largely returned to pre-COVID levels, but visitors from China are still about half of pre-COVID levels. And overall, tourism's back to about 77% of pre-COVID. Meanwhile, New Zealand's terms of trade have taken a downturn, so some of our key exports are exposed to the Chinese consumer sector. Lack of demand out of China has led to weak prices for many of New Zealand's key export products. Ministry of Primary Industries tells us that revenue decline is expected in dairy, meat and forestry for the year to June 2024. And meanwhile, for those industries, actually costs are on the rise, not least interest costs. So actually, in some of our key goods exporting industries, profitability is under a bit of pressure. And as you can see, the terms of trade, which is the price we receive for our exports versus the price we pay for our imports, did deteriorate during 2023. Now, we are expecting recovery there from this downturn in the terms of trade as China's economy recovers. But over 20 or 30 years, New Zealand experienced a really steady increase in the terms of trade, sort of decade on decade. And actually, those highs were all-time records. We're not expecting ongoing sort of secular improvement in the terms of trade from here. I'm sure you've all read the news. You know that the world is becoming more geopolitically fragmented. That may lead to it becoming more economically fragmented. It's a phenomenon known as globalization, as sort of the slowdown in the growth of trade, I think will negatively impact New Zealand, and we're expecting a flatter line for our terms of trade from here. So if we get in closer to the domestic economy, just focus your attention on the left-hand panel to start with. The first thing that we were dealing with after our half-year economic update was given was actually the September quarter GDP numbers revealed a really large downward revision to the history of GDP. So Stats New Zealand came out and told us that, look, over the previous year or so, or 2 years, there's been, the economy just hasn't been as big as we'd previously measured it as, and that downgrade was worth 0.8% of GDP. The September quarter GDP number was a good 0.5% lower than our forecast. So as we learned about this, we realised that in the recent past, the New Zealand economy had actually been quite a bit weaker than we'd previously been counting on. And interestingly, we'd been observing quite weak tax revenues and had been surprised by that relative to what we were getting out of the measured economy. And this kind of explained to some extent that mystery. Then as we went into the new year, we start seeing very, very weak data, particularly on the consumer side and particularly in residential construction. Peter Gardner, our head of forecasting, is here to help me with questions later. Him and his team went out around the country to do business visits. Those business visits were unambiguous in just how much the business environment had weakened in New Zealand, with firms, particularly again in construction, just telling us how much things had slowed. So it became apparent that in the near term, the downturn in the economy, long expected, but it was here a little bit sooner and is going to be a little bit deeper than we'd previously expected. Just a couple of bits of context. I mean, first, we are still expecting a recovery. You can see that in the chart. Second, this slowdown for the New Zealand economy. So things have dropped, GDP has dropped 0.7% in total. It follows a very, very strong period of growth previously, actually. And if you compare us to other countries, New Zealand sort of roared out of COVID ahead of other countries. Our subsequent downturn has been harder, but in levels terms, it puts us back within the pack, really, across the world. And I guess it does illustrate that those measures that led to growth post-COVID, that did need to be sort of repaid in time. That's why we've had a more vigorous monetary policy cycle. The other key piece of context here is net migration, so population growth. Net migration, we knew it was booming, but actually at the half-year update, our forecast of the peak was 118,000, which was just an unprecedented number, a peak for annual net migration. Subsequently, again, revisions and actual outturns have revealed that the actual peak was 148,000 people net migration, which is the highest number that Aotearoa's experienced in its 1,000-year history. This really strong population growth means a couple of things. One, the downturn is much more severe for households than it is for businesses. So businesses are telling us, consumers are a bit more cautious, they're not buying as much, but there are more of them. For households, actually, on a per capita basis, GDP has fallen 3.9% since the peak, which is more severe than the slightly more severe than the global financial crisis decline in GDP per capita. So for households, this really has been quite a severe downturn, albeit I gave the context before that it was after a big up. So, as I said, we're expecting a recovery in time, and I guess the question for you is, when are we going to get that recovery? You know, what's going to drive it? It's all about inflation. So I can remember a number of years ago sort of giving macro updates like this, and you'd start talking about inflation and you could just see people's eyes roll and they would switch off and not care, and I'd be thinking, no, inflation really is the key. It's really key. And I think we've had a salutary reminder of that over the past few years. First of all, high inflation really stretches household budgets and affects people across the community. Secondly, high inflation requires that monetary policy response, and again, that is driving what's happening across the short-term economy. Now, we are expecting inflation to return to within the Reserve Bank's target band and eventually return to 2%, and as that happens, we'd expect interest rates to decline. What we are seeing, though, is that inflation's dropped from sort of 7.6% to 4%, but it's tradables inflation that has dropped fastest. Actually, non-tradables inflation has only fallen from a peak of 6.3 down to 5.8. And the March quarter inflation figures actually came out after we had finalised our economic projections, so they're not part of the budget economic projections, but again, non-tradables inflation proved more persistent than we were expecting. So non-tradables is those domestically generated side of things, particularly we're seeing it in rates, rents and insurance. What you tend to get with administered prices like rates is they're often tied to past inflation outturns, or at least to some extent are a function of past inflation outturns, so you do get a bit of persistence. But the thing is, with non-tradables inflation proving persistent, it's going to be a little, and the Reserve Bank's been saying this, it's going to be a bit trickier for them to cut interest rates. So that persistence in domestic inflation just mean the Reserve Bank will have to hold rates a bit higher for longer. And again, just bear in mind that their last set of forecasts did include the latest inflation number, ours didn't, and that's a cause of slight difference between the two forecasts. So because of this, we think it's going to be a bit of a while until interest rates can fall. On our forecast, it was late this year that we saw the 90-day rate starting to decline. The most interesting thing about that chart actually is just think back to the bigger downturn that we're seeing in the economy. Big difference in the two GDP lines, but only a small difference in the interest rate lines. And that's because of that persistence in inflation. So you could say, despite the really weak economy, Reserve Bank is going to be sticking to roughly the same interest rate path in our view as previously forecast, because on the other side of it, you've got the persistence of inflation. And then these high interest rates, of course, are slowly filtering through to the mortgage rates that households actually pay. So the effective mortgage rate, or the average mortgage rate paid, has already doubled from 9.5% of income to roughly 18%. There's further to go on that as people continue to roll onto from low fixed mortgage rates onto higher fixed mortgage rates. So it's going to carry on for a while, but we do expect interest rates to come down in time, and then all of these processes go into reverse and you get the recovery. Now again, those high mortgage rates really are affecting consumer confidence. You can see it's very, very low here, and again you can see private consumption, this is 70% of the economy, and it's the stuff that all of the households buy, has declined recently. And on a per capita basis, again, goods consumption in particular has absolutely slumped. Again, on those business visits, when we talk to retailers, what they said is people are buying, good rather than best. They're putting perhaps 6 items in the basket rather than 8. They're still in the shops, but they've just downgraded a little bit how exuberant they are in terms of what they buy. The other side of monetary policy doesn't just work through mortgage payments. I mean, you have to remember some people are savers, and the increase in interest rates is actually a boost to their incomes. Another way that it works is via the housing market. So house prices, our latest forecast is the blue line. half-year update is the black line, so they've proved just a little bit weaker than we'd previously anticipated. By the time you consider there was an enormous, just during COVID, run-up in house prices, an 18% decline afterwards and very slow growth over the past year in an environment of roughly 7% inflation. So actually what's happened to real house prices is that they've returned to their pre-COVID trend. Now we're expecting house price growth in the order of about 2% per annum going forward. One thing that is in here is tax changes were made to the ability of landlords to deduct mortgage interest from to claim tax deductions for mortgage interest. Now that, in our view, there's also a change to the bright line test. We've done work on that. We assess that the impact on house prices is roughly upwards in the order of 2 to 6%, but we've incorporated a 3% sort of allowance in this forecast for within that 2 to 6% range. The other thing is what's happening with rents. So rents are basically a function of what's happening with wages, which have accelerated sharply recently, and supply and demand. And I've talked to you already about a construction downturn and a migration upturn. So that supply demand is changing. So rent inflation is accelerating. It's hit 4.5% in terms of the average, not new rentals, but the average of all rentals. We think that's going to continue to accelerate to 5.5% and won't particularly be affected by that tax change. Now on the construction side, residential construction is often the biggest swing factor in New Zealand economic cycles. And the reason is during a recession, you have to eat, but you don't have to renovate your house or upgrade your house to a bigger house. So it becomes more discretionary and people tend to be more in or out in residential construction. And then, of course, when the housing market is very lackluster like it is now, there's a less incentive to, or less exciting for developers to be in there building new houses. So residential construction's fallen 4% during 2023. We expect a further 11% decline over 2024. Again, we do expect a recovery there over time, but we know it takes a little while in that industry. Actually, that swing is quite a bit smaller than we experienced during the global financial crisis. On the business side, as I've mentioned, our business confidence is low. It's not as low as consumer confidence. We are seeing a downturn in business investment, and again, through observed intentions or through our business contacts, we're expecting a further decline, 6% decline in business investment. But there's a couple of things on the other side. There's a really big infrastructure pipeline there, both public and private. That's keeping business investment aloft. And as I've mentioned, there's that population growth. So the downturn in business investment's not quite as severe as what we're expecting for households. And again, there, as interest rates fall, we're expecting a recovery. Government is playing its part in helping monetary policy to slow things down to something more sustainable. So government consumption has already declined, and we're expecting a further decline over the coming couple of years. So government consumption is the things that government purchases on our behalf. A lot of education is purchased by government, pretty much all of the policing, all of the armed forces. Central government administration is part of government consumption, a lot of health. Now, the peak there was really related to COVID expenditure. So there was a great deal of government consumption to assist with managed isolation and all the rest. So that's obviously come out. And as you know, there's a savings program in place that is also reducing government consumption. As I'll get to later on, there are ongoing plans, or government's fiscal forecasts imply further declines in government consumption going forward. And this is in an environment where we've got population growth that's reasonably robust. So actually, the forecast already incorporated in this forecast is a 10.5% per capita decline from the peak in government consumption. And that would be the biggest decline in government consumption relative to GDP on record. So it really is, the savings program and what we have in place at the moment is just the start. The fiscal forecasts imply ongoing savings and ongoing restraint on government consumption going forward. Just a little bit more on the external sector. So the current account deficit got out to really quite worrying levels, 8.5% at the peak. So this is what we receive for our exports or investment earnings and the like versus what we're paying overseas. Really the big hole was because we had not much of an international tourism industry during COVID. And the recovery in the current account that we've experienced so far and are expecting going forward is largely to do with the big recovery in tourism that we think will be ongoing. There was also goods exports were affected by the North Island weather events last year, and we are expecting something of a recovery there. As consumers in New Zealand rein in their spending, it's coming off the import bill. And lastly is profitability of firms. So we are expecting the current account deficit to return to more sustainable levels. And in fact, that's well in train. That forecast is already sort of played out about halfway. So, you know, the overall economy, I've talked about the reasons for the downturn and the reasons for expecting a recovery over time as monetary inflation normalizes and monetary policy normalise. The thing about recessions is that they often feel worst towards the tail end. So we've actually, four of the last 5 quarters have been negative for GDP. This is arguably a year or more into what history will call this recession. And it's only really recently that we're really starting to see sort of front page news about unemployment, for example. It's risen from 3.2% to 4.3% already, and we're expecting it will continue to rise to 5.3%. Unemployment does tend to be a bit of a lagging indicator, so the peak in unemployment will be after the low point for the economy. And you can see as the recovery begins, we'd expect unemployment to drop away. On the wage front, again, that's tended to follow inflation. So inflation hit sort of unexpectedly and suddenly. Real wages adjusted for inflation, really fell about 2% as a consequence. Subsequent to that, during the tight labour market, workers have caught up, real wages have risen. Going forward, we'd expect wage growth to start to diminish as unemployment rises and as inflation drops away. Okay, just fill up with water. So that's the economic side. I'll turn now to the fiscal side. So, sorry, actually, no, I've forgotten one thing, and that's the all-important productivity piece. So I've talked about the short-term downturn, but that is not a big driver of a 4 or 5 year revenue forecast for the government. Because if the downturn turns out sooner than expected, well, you'd expect a recovery over time. Perhaps it's sooner, it's not really lasting. The really, really important thing in the Treasury's economic forecast this time was a change to our assessment of productivity growth over the coming 4 or 5 years. So productivity is how much you get, GDP per hour worked is one common measure of productivity known as labour productivity. Multi-factor productivity is how much GDP you're getting, how much output you get for 1 unit of labour or capital. Either way, New Zealand experienced quite rapid productivity growth in the mid to late 90s and into the early 2000s. From 1993 to 2003, labour productivity growth averaged 1.4%. However, over the past decade, the average of labour productivity growth has been 0.2%. So there was a really marked slowdown in productivity growth around the early to mid 2010s, sometime after the global financial crisis. Now that was, you can see in the chart there, it was ongoing prior to COVID, but perhaps during the early 2020s, we saw a really large pickup in productivity growth. And we thought that was probably temporary and related to to COVID. But it was unclear exactly, between the slowdown and then the pickup in the early 2020s, where does the trend lie? We did take a conservative approach, but over the past year, a lot of workers have hit the New Zealand economy and GDP growth's been very weak. And actually measured productivity, labour productivity and multi-factor productivity have come back down to the previous trend. And it looks to us as though the trend that had asserted itself from the early 2010s for about a decade there has continued, and it was only briefly interrupted by COVID. It now sort of seems clearer. Now that's a read of it from just from the data, but this is a really important thing to consider. So we dug deeper over the past 6 months. We did some fast turnaround research, and I was really pleased that we were able to publish it and explain some of our thinking. So published a piece on the productivity slowdown, and it drew on the productivity-themed guest lecture series from the past year, as well as global research and our own research, obviously. What we found, the upshot of that research, is that the productivity slowdown was global, or is global. So countries around the world are experiencing this slowdown in productivity growth. There are a range of possible causes for the slowdown, but no one that sort of just sticks out as, yes, you could point your finger to exactly that one. But it's likely that innovation is happening around the world, but it appears that the diffusion of that innovation is not really, New Zealand is not benefiting from it as much as it could. Investment in New Zealand has not been sufficient to exceed growth in the labour force. International trade opportunities, I've already talked about the fragmenting geopolitics of the world and globalisation. This could be interrupting our ability to participate in global value chains, which add productivity worldwide. Very, very strong employment growth. I mean, the last worker you add is less productive than the average worker. And there's actually even a possibility that this is the cause of mismeasurement. What we measure as GDP is changing. Map reading is no longer part of map buying. Sorry, it's no longer part of GDP, for example. But actually, on that, your GDP per hour worked and your tax. So things that affect your GDP probably also affect your ability to collect tax. So the mismeasurement point doesn't really affect our thinking too much. Either way, looking at this range of possible causes of the global slowdown in productivity growth, none of them appeared to be something that was about to turn around. There's all sorts of things that you can do to improve productivity growth as best you can, regulation, international connections, infrastructure and the like. But our read on the things that have contributed to the slowdown in productivity growth, none of it looks as though it's about to imminently turn around and yield the types of productivity growth that we were forecasting a year ago. So that research and literature review sort of convinced us that this lower productivity forecast, or the most reasonable forecast, is lower than we had previously allowed for. And that brings us to the junction between the economic and the fiscal. So the bottom line for a fiscal forecast, when you forecast revenue, it's nominal GDP really that's the big driver of your forecast of revenue. And as I've mentioned, not only is the near-term downturn earlier and deeper than previously thought, that's on the left-hand side, but actually our forecast of nominal GDP over 5 years is lower than we were forecasting 6 months ago because of this new evidence around productivity. So that led us to conclude that, okay, this weaker economic outlook over time reduced the revenue forecast by approximately $9.6 billion over 4 years. The other thing that affected our revenue forecast is that we're actually collecting quite a lot less revenue than we had previously anticipated. So both IRD and Treasury have a close interest in what's happening to revenue collections over time. In the 2024 year, actually the March month is a really big month because a lot of firms work to a March year and settle their annual tax payments at that time. Corporate tax revenue for the 2024 year came in $2 billion weaker, or now looks likely to come in $2 billion weaker than we had allowed for at the half-year update. Now that's off a $20 billion base, so it's a 10% surprise. And that is actually the nature of the beast for corporate tax revenue. It's extremely volatile and extremely hard to forecast. I was talking to Australian colleagues who they were bringing up about sort of performance metrics for their revenue forecasters, and corporate tax revenue was not even in their performance metric. So it's just a very, very volatile thing. It does tend to be cyclical though. So what this tells us is that firms have proved less profitable than one might have expected, even if one had known how deep the economic downturn was going. So for any given level of the economy, corporate tax revenues turned out weaker than anticipated. And you can see that it's cyclical, so we expect a recovery, but it will take a few years. And this contributed to a further $9 billion downgrade in our revenue forecast. So by the time before governments made any decisions, Treasury has assessed that the likely path for revenue is $18.5 billion weaker than previously forecast. And then, of course, the third element of revenue is tax policy. So there have been a range of tax policy changes. We've got changes to personal income tax thresholds, independent earner tax credit. We've got the changes to interest deductibility for landlords, depreciation allowances for commercial landlords, and a gambling tax. A range of revenue changes on both sides, but they also, on net, worth $9.9 billion over 4 years. So that's a further source of reduction in the government revenue forecast. And you can see the latest revenue forecast is blue versus the half-year update green. We've got $28.5 billion lower forecast for revenue over the course of the forecast period. Meanwhile, I've already mentioned that government is working hard to reduce expenditure. So we've got baseline reductions and a range of other expenditure measures, a plan to live within very tight allowances, which I'll talk about shortly. So the revenue forecast is $16 billion lower over the 4 years than previously forecast, blue versus green again. So you can see that those revenue decisions have offset those expenditure decisions have ameliorated the impact of the reduced revenue. It's not a full offset though, and so the balance, Obergall on the left-hand panel there, fiscal balance deficits are a bit larger, and we return to surplus 1 year later than forecast at the half-year update. Now, at this point, it's important to distinguish between things that are outside of the government's control and things that are inside the government's control. So I've mentioned that the corporate tax downgrade, the economic downgrade, those are essentially exogenous as far as government is concerned. So it's important also to focus on the decisions that government made. This is what people are talking about, and they're best summarised in the allowances. What the allowances are at each budget, it's the net average cost per annum of decisions made during that budget. So previously, the planned allowance for budget 2024 was an average of $3.5 billion, decisions that cost an average of $3.5 billion per annum over the subsequent 4 years. Instead, what's actually been delivered is a package that costs on net $3.2 billion. It's really important to remember that allowances are a net concept. So there's actually a lot of moving parts within any budget. This is the summary of the budget 2024. We've got new spending worth $5.4 billion, but we've got spending restraint on the other side. We've got some revenue raising initiatives, some tax cut initiatives, and the net between the gross costs and the funding is $3.2 billion. So the government actually reduced the net cost, including tax cuts, of the budget was smaller than the previous allowance. And that's what the government means when it says that the tax cuts were fully funded, or that the net is down. Secondly, planned allowances for the next 3 budgets are smaller than the previous plan. And these two things combined are worth $5.5 billion over the 4 years. Now, these $2.4 billion allowances, though, they are going to be tight because we have pre-commitments. So health funding is multi-year. Quite a lot of the $2.4 billion allowance for budget 25 is already allocated. There's $0.9 billion left. There's $1.5 billion left for budget 26 and the full 2.4 for budget 27. Treasury did, there's a box in the budget, we did a rough and ready analysis of likely cost pressures. So the cost of delivering what the government currently delivers is likely to increase by about $2.5 billion per annum, or estimated to increase about $2.5 billion per annum for each of the next 3 years. And then you've got population growth to consider on top of that, because delivering what the government currently delivers is sufficient for today's population. The population's obviously going to grow. So actually, to accommodate pre-commitments, cost increases and population growth, it's going to require tough decisions for the government to live within $2.4 billion allowances for the coming 3 years. And again, this gets back to my point that in these fiscal and economic forecasts, actually spending restraint by government and tough decisions by government are already factored in. And again, that matches the expectation for government consumption, for example, to decline on a per capita basis over time. So lots more savings measures are already factored in to these allowances. And exactly what they are is a decision for government to make. They will make that over time, at the appropriate time, at the appropriate budgets. But just do bear in mind that these are net concepts. So there are a range of ways that government could live within the 2.4. It can fund things. It's a net concept. Okay, so that's so again, the upshot here is revenue shortfall means bigger deficits. Government decisions ameliorated that to some extent and meant smaller deficits than if the government hadn't taken those decisions. The next question is, was it inflationary? What's fiscal policy's effect on inflation? And it's actually much the same, just at the most basic level, it's much the same as the thinking about the surplus or deficit. So first thing, the revenue shortfall, which means, I've explained it means bigger deficits. Well, basically that means government is extracting less from the economy than it's pumping in, and an objective assessment of fiscal policy, of where it has been, is and will be, is more inflationary than otherwise. The Reserve Bank made this point. The way they expressed it was that government expenditure, the downgrade to potential GDP, means government expenditure as a proportion of GDP is higher than otherwise and is therefore more inflationary. So that's the stuff that's outside the government's control. It is an objective assessment of the role of fiscal policy at present is, or has been, is and will be more inflationary than previously articulated. By the way, that doesn't necessarily mean that you go out and change your interest rate forecast, because government's turned out to be a bigger part of the economy in recent years, but we know what the size of the economy is, so it must mean the private sector's been even weaker. All right. Secondly, government decisions have been clearly disinflationary. Okay. So the revenue shortfall means bigger deficits, stands to reason that fiscal policy as a whole has been, is and will be more inflationary. But government took decisions to ameliorate that. The smaller deficits mean that the contribution this budget makes to inflation is smaller than it would have been if the government had made no decisions. And actually, it's not just as simple as, well, the deficit, they've pulled the deficits back a bit. It's because not all forms of revenue or expenditure are created equal. And our actually tax cuts equal-sized tax cuts and spending cuts would themselves actually be slightly disinflationary because tax cuts are more likely to be saved than the spending cuts. Okay, so for two reasons, the actions that the government has taken are in the direction of lower inflation. And then thirdly, and this hasn't changed, the forecast deficit, of course, gets smaller over time. So the contribution fiscal policy is making to inflation gets smaller over time. So fiscal policy over the coming 4 years is going to be a friend to monetary policy in the sense that it is going to become, more balanced. Government's role in the economy will become more balanced over time. And we can see that in the fiscal impulse measure, which is our sort of bottom line indicator of the inflationary or otherwise stance of fiscal policy. You can see that we're flipping to negative, which is contractionary relative to the previous year over time. So at this point, it's worth thinking about, it's worth just discussing the government's fiscal strategy. These are actually decisions for government, so I won't get too much into them. But really, the point I'd like to make is that there's many goals for fiscal policy. So balancing the books is something that does have to happen over time. It's important for fiscal policy to the extent that it can to be a mate to monetary policy. But then fiscal policy, you also want to make sure that you're purchasing the goods and services and making the transfers that you want to make, that you're collecting your revenue in an efficient manner, that you're providing a stable and economic environment in which firms and households can make well-informed decisions. There's many things that fiscal policy aims for. It's not just about, I suppose you want to spend your time thinking, well, if you delivered a revenue shortfall, what should the government strategy be? You learn the economy's weaker and we're collecting less tax revenue than you'd previously expected. What is the best fiscal strategy under those circumstances? And again, it's a decision for government, but the fiscal strategy that that government has adopted in the short term, they've decided that surplus by 27-28. It's one of their short-term fiscal targets, and putting debt to GDP ratio on a downward trajectory towards 40%. Government is also required to set long-term fiscal targets. That's keep debt to GDP between 20% and 40% subject to economic shocks. So again, it's not balance the books at all costs all the time. It's not react immediately to all changes in the revenue forecast. It's kind of between 20 to 40% depending on shocks. And control government spending so that core crown expenses to GDP reduce towards 30% over time. So that one's about the size of government as a whole. If you're balancing the books, both revenue and expenses should be about 30% of GDP. That's we're currently just over 32, so a bit of work there to get size of government lower. Okay, so I'll just finish with a couple of kind of reminders. I mean, I've covered the basics of the reason for the economic downgrade, the reasons for the revenue downgrade, the government's response. And I think that key point that, yes, there are bigger deficits, but government decisions have ameliorated that, or the role that fiscal policy has played in inflation probably is bigger, and government's decisions have ameliorated that to some extent. Those are the summaries. But there's always, the only certainty in this world is uncertainty. Economic forecasters or forecasters don't make forecasts because they know the future. They don't have crystal balls. They make them because they're asked to, because we need them to make good decisions. We've done a review of our revenue forecasting recently. Actually, we found we're pretty good at it compared to overseas counterparts and compared to just naive models of revenue forecasting, but it remains very uncertain. So we produced this fan chart in the update, which illustrates that within 70% of the time we would expect revenue in 4 years' time to be within $11 billion of our forecast, and 90% of the time we'd expect it to be within 18. So those are pretty wide bands. Admittedly, this is based on the history of our forecasts versus the history of actual outturns. So one of the things that could happen is policy changes. So it's not really just down to our forecasting. It's also policy changes kind of in the mix there. I would like to improve on that, but it's a bit of a research project that could take some time. Main point is those forecasts are really, there's quite a bit of uncertainty. A shock could come along and change revenue, and the economy could turn out different to expectation. Lastly, is the long-term fiscal outlook. So Treasury will be providing a long-term fiscal statement in 2025. We last provided one in 2021. We've constantly been regularly making the point that New Zealand needs to make changes if its fiscal policy is to remain sustainable for the very long term. We've actually recently published a great piece of research. The authors are in the room with me today, actually, on the incidence of fiscal policy. And basically what it's telling us is that in New Zealand, we spend, if you break down by age group, what people receive from the state and what they pay to the state. You will see that people receive more early in life, they pay on net in midlife, and at the end of life, people, New Zealanders receive really quite large transfers and also in-kind payments, healthcare and the like. The thing is, in New Zealand, this is larger than in other countries. So our fiscal policy is actually quite weighted towards people aged over 65. Therefore, as the population ages around the world, it's not just how rapidly your population ages, it's also to do with the structure of your fiscal policy. Our aging problem is not as bad as some other countries, but or I shouldn't say bad, not as, our population is not going to age as fast as some other countries, but our fiscal policy is actually more oriented towards the over 65s. And that means as more of the population, currently, 16% moving to 25% by 2060 over 65, that will put quite a bit of stress on New Zealand's fiscal position. What that means, I don't want to prejudge the 2025 long-term fiscal statement, but in 2021, we pointed out that current tax and expenditure policies will lead to an unsustainable, if unchanged, would lead to an unsustainable fiscal position over the coming 40 years, and an explosive debt position. Now, that's not a forecast. It's not what we think is going to happen. The point is that changes need to be made in order to bend that curve back down and keep it sustainable. And actually, there's great uncertainties. This chart illustrates the uncertainty around the interest rate. The bottom line is what would happen to debt at a 2% interest rate. The top line is a 5.5% interest rate. So what happens to interest rates actually really matter for how unsustainable debt loadings become. And the other thing is the population itself. It's very uncertain how large the New Zealand population will be in 40 years' time. And again, that has a great bearing on how sustainable our current fiscal policies are. So there's a great deal of uncertainty in this, but Treasury has consistently been making the point that change needs to be made to expenditure or revenue over time if we are to keep fiscal policy sustainable in the face of an aging population. So I just thought I'd finish with a reminder that this is an important long-run challenge for New Zealand. Okay, and with that, I will wrap up. Thank you very much. And we will turn to questions. I think we'll leave about 15 minutes for questions. I think we've got some people in the room, we've got some people online. I've got some, I'm not going to be able to answer all of the questions. So I've got Peter Gardner, our head of forecasting. I've got Ben Gauk-Roger, our manager of our macro and fiscal team, and I've got Kamlesh Patel, the deputy chief government accountant, all here to help me answer questions if they're too detailed. But any from in the room while Peter gets things lined up on the computer? Or are there online questions, Peter?
Yeah, there were a few online questions. There's a few comments as well, which is really good to see. I'm hopeful you will be able to answer all the questions.
Oh.
The first one is actually really quite a good question. It came from early on in your presentation when you talked about the timing of interest rate cuts. So could you explain perhaps a little bit more of the reason why we thought interest rates would be decreasing at the end of the year? And if the Reserve Bank wasn't to follow the interest rate path that we've forecast, what would that mean for the economy?
So, yeah, there are differences between the Reserve Banks and the Treasury's interest rate forecast. Obviously, the Reserve Bank is what happens to interest rates is a decision for the Reserve Bank. The first thing to bear in mind is we completed that forecast before the crucial Q1 CPI number. So non-tradables inflation turned out 0.5% higher than the headline matched our forecast. Well done, Peter. But non-tradables inflation was much more persistent than previously expected, and so that was one source of difference between our forecast and the Reserve Bank's. On the second part of the question, what would happen if instead of following our projection, monetary policy followed the Reserve Bank's projection? Well, it would depend on the reasons why. So if the economy turned out more resilient or inflation turned out more persistent than anticipated, I would expect interest rates will be falling, later than in our forecast. If it was a difference in the way the central bank's behaving, so if we learned that they were choosing to keep interest rates high for longer, well, we would adapt our growth and inflation forecast, we would reduce our inflation forecast, and we would reduce our growth forecast in the near term. We'd also build in an earlier recovery, by the way, and an earlier return to 2% inflation if it was for that reason. And we're the same as any other forecaster out there. So the banks all have their economic forecasts and their interest rate forecasts, and they're simultaneously trying to anticipate what's going to happen to the economy and how the central bank is going to react to that. We're in exactly the same position. We don't have additional knowledge of what they're doing. We produce our forecast in the same way, and our forecasts are, at the time we finalised them, they were very much in the band of other forecasters.
Staying on the theme of the Reserve Bank then, are you able to explain briefly how we might think about the impact of debt to income ratio on the impact of house prices and maybe more generally the economy?
So debt to income ratio referred to there as a macroprudential policy of the Reserve Banks, limiting the frequency with which banks can lend at lend amounts that are high relative to people's incomes on housing. The first thing to bear in mind is there are already loan-to-value ratio restrictions out there, which restrict bank lending to some extent. And of course, bank lending itself is restricted by the interest rates of people's propensity to borrow. Our assessment is that debt-to-income ratios at present, they haven't played a large role in our house price forecast, and that's where you would expect to see an impact on the economy. So it hasn't played a very large role in our assessment of the macro economy. There may well be differences in who is able to borrow and who's able to purchase the houses, and there might be microeconomic differences, and I think those are questions best left for the Reserve Bank's Prudential Regulation Department.
Thanks. There's a couple of questions relating to the contraction in government sector at the moment and what that's likely to mean for regional economies and the labour market. Have you got any sort of broad thoughts on those two potential issues?
Yep. So government is cutting back, and I think the thrust of the presentation is that is consistent with the wider economy. So we are seeing private sector's cutting back, government's cutting back. Actually, the private sector may not be. Government's been shedding workers recently. I imagine that is going to have an effect on the Wellington regional economy, and of course, there's always, it's never great to see people out of work, and it will certainly affect the individuals and communities. At the macroeconomic level, we're looking at a number at the moment. public sector redundancies are in the mid-single thousands against, an unemployment figure that's around 200,000 in total. So it's material. It's there. It's part of the equation, and it will contribute to unemployment. But just in terms of I think the effect is probably more concentrated in central Wellington, and obviously for the people concerned at the macro level, it's I've given a sense of the size.
Thanks. There are a number of other specific questions or comments that I think we'll be able to follow up on later. And there was one other question that I just wanted to follow up on, which I'll do now, but I just wanted to sort of throw it open to the room again to see if there are any questions. Gerald.
Gerald Monet. I was interested in whether the Treasury had looked at how much net migration would have to increase in order to dent the rising debt curve that you showed on your projection graph. In the past, I've taken it as given that net migration wouldn't affect the age structure that much, just a little bit, but we were thinking in terms of 10,000, 20,000 kind of as a good clip, not 100,000 kind of rates of levels of net migration.
Yeah, so net migration has a range of impacts on the economy and on fiscal policy. So, on the economy, it adds workers, but it also adds demand. We typically have thought of it as adding a little bit more demand than it adds to supply, so it tends to be on the inflationary side. It's similar on the fiscal side. Net migration adds taxpayers, but it adds people who consume government services as well. It does alter the age structure. Yes, it alters the age structure relative to the counterfactual, and I suppose if you had ongoing forever very, very high rates of net migration, then your age structure until those migrants had aged for quite some time, you'd have a slightly different age structure. Have we done? I don't think we've done that exact analysis, but just to be clear, both our fiscal and economic forecasts are predicated on a return to 40,000 net migration per annum, which is a lot, as you point out, is a lot higher than we used to deal with. Obviously, if net migration turns out different to that, then both the economic and fiscal forecasts will be affected.
That seems
Oh, do you want to just grab the mic so people online can hear?
Thanks, Tom. It's very helpful. James from KPMG. Think about climate change impact, and can you see a time where that actually gets featured into some of the forecasting models?
Climate change is a critical part of certainly of fiscal policy and of government policy. So, I mean, I've given a presentation on sort of the macro outlook and the growth outlook. There's a really a vigorous program of work on both the adaptation and mitigation side at the Treasury, giving advice to government. On the macro side, I think, and fiscal side, we would point to climate change as one of the things that could hold back productivity growth. It's one of the things that could hold back growth in potential GDP. So that has been thought about in these forecasts. And then, of course, there are great fiscal risks on both the capital side and the expenditure side related to climate change. It's really hard to sort of put your penny down and make a forecast there because it really depends on the way government reacts. So, for example, as we get as sea levels rise or as weather events become more severe and certain locations become, for all intents and purposes, difficult to inhabit or prohibitively expensive to insure, to what extent will that proves a fiscal risk for government will depend on choices that governments make. So all I can say at this point is it's something that's being thought about. So to answer your question, from a number of years ago would be, we've been thinking about this for years, but it's impossible to put a number down at this. It depends on government's choices.
I'd add perhaps two more things. So, yeah, as Dom rightly points out, as we get more evidence and as we're more certain of that evidence, it will get incorporated more formally into our forecasts. But where we do see, large weather events like the North Island floods last year, we'll cost those and appropriately incorporate them in our economic and fiscal forecasts. And if I just referred back to the previous long-term fiscal statement, one of our colleagues did a really nice bit of work that looked at the fiscal implications of more frequent, more devastating tail-end events or weather events. So that gave us a little bit of insight into what the potential fiscal impacts are. I guess when we were talking about this the other day, what we probably did was underestimate just how severe some of those events were going to get so quickly. So that's another bit of work that we'll probably look at redoing for next year's long-term fiscal statement, potentially. I haven't got any other further questions online. Hilary, was there anything else that's worthwhile picking up? No? Okay.
Okay. Any other questions in the room? Oh,
Here we go.
there's a couple. Probably make this the last one. And then.
Kia ora, I'm Yava from MSD. I have somewhat of a half-baked question, but with my limited sort of very economics knowledge, this feels like a very broad sort of lead into, I guess, a recession, in that you have all of those non-tradable factors affecting inflation. And for me, I was thinking back to the COVID-19 sort of downturn, in that a lot of the people who were affected were like women and part-time workers, youth. I was thinking, is there any specific population groups do you see that would be more affected by this sort of downturn coming or happening?
So in the current downturn, what we're seeing is it's actually the construction industry is probably the biggest. We've got one of the things that we do is the child poverty report accompanies the budget. What that revealed is that inflation had quite an effect on child poverty. So there are three different measures of child poverty. One is material deprivation, so how many people are without certain items. One is how many children are in poverty as measured relative to average wages, and one is an absolute measure relative to wages a number of years ago. All three measures worsened essentially due to inflation. The absolute measure, we don't forecast material deprivation. The absolute measure is forecast to return to a declining path going forward. And the relative measure is essentially forecast to flatline from here. So key point is child poverty really was quite impacted by the cost of living, if you like, and that the fact that inflation tends to have a greater effect on people on the lowest incomes because they're spending the greatest portion of their income, essentially. And they're spending on items that were rising fastest in price. Okay, let's close here. Thank you very much. Thanks very much to those online. Thanks to those who joined me in the room. I hope you found it illuminating, and give us some feedback, and we'll sort of tweak it for next year, or do it again if we get lots of positive feedback. I'll close with a karakia, piki te kaha, piki te ora, piki te wairua, huie tai kie.
Thank you
Very much, Peter.